So, with so many people, including myself, feeling like the stock market is kind of being propped up right now while the economy just barely continues to limp along after being so heavily destroyed, one investment strategy that a lot of people have been turning to is dividend investing. And that is because if the company is stable enough and if management is committed to paying out those dividends over a long period of time, then dividends can be a great steady source of income through all of the volatility and regardless of what the overall market is doing. Well, in today's video, we're going to talk about 5 stocks. It's actually 4 individual stocks and 1 ETF that I personally like for long-term dividend income. But as always, this is just my opinion, guys. Please do your own research and obviously only buy stocks at the price that you feel comfortable with based on your own extensive research. But with that said, we got a lot to cover, so let's go ahead and get started. By the way, I'll leave you timestamps down below in case you need them. All I ask in return is that you please hit the like button if you enjoy the video, as it really helps the channel and it means a lot to me. But with that said, let's go ahead and kick things off with the only ETF on the list, and then we'll move on to individual stocks right after. Now, if you don't know what ETFs are, they're basically like a collection of many different stocks. So there's a lot of diversification within just one single investment, and that diversity can really help the ETF get through some tough times. And if the ETF is focused on paying out dividends, then it makes it much less likely that they would have to be cutting their dividends, whereas a lot of individual stocks may actually be cutting their dividends. An ETF might not have to do that. So it's overall just kind of a safer option to be able to just throw some money into an investment and be able to collect dividends over a long period of time consistently. And so the ETF that I chose for today's video is definitely one that is focused on dividends, and that is the Vanguard High Dividend Yield ETF. Ticker symbol is VYM. And there's a few reasons why I really like this one in particular. For one, it's literally in the name. This is a fairly high yielding ETF. At close to a 3.7% yield, it's definitely up there with some of the best ETFs in the market, especially considering that it's not just holding a bunch of risky like oil stocks or real estate investment trusts that do usually give you a higher yield, but also come with significant added risk. So there's kind of a trade-off there, but we'll talk more about that in just a second. And despite having such a high yield, it still has close to a double-digit growth rate and a decade of consecutive growth, meaning that for every single year in the past 10 years, this ETF has actually grown its dividend payout consistently. Now, they did lower it a little during the Great Recession, but it wasn't by very much, and they quickly returned to solid growth immediately after. So as long as you didn't sell, but instead maybe added even more to your position during any of those dips, then you really should have come out a winner with this one. Which brings me to another reason why I like it, and that's that it's actually down quite a bit this year at close to a 15% year-to-date drop at the time of this recording. Granted, it was down more during the March lows of this 2020 crash, but considering how high the overall market has been recently, being able to pick up this ETF at about around the midpoint of its 52-week range doesn't look like that bad of a deal to me at all. As you can tell from the chart though, this isn't really a high-flying ETF by any means. Instead, it's more of a reliable dividend investment that you can hold on to long-term and count on for some pretty good stability and some nice dividends, which brings me to the final reason why I like it, and that's how well diversified it is. It screens an enormous amount of US companies that have high yields, but it also excludes riskier real estate investment trusts and then weighs them by market cap rather than by dividend, so it ends up having greater exposure to the larger, more solid companies, which may have lower yields, but the trade-off is an overall more stable and reliable ETF. I'm not going to bore you going through all the different sectors, but if you just take a quick glance at this screenshot, you can see that their exposure is very well balanced across many sectors, which can also be seen in some of their top holdings, which I also really like. First of all, their top 10 holdings only make up less than 30% of the ETF, which means that they own a lot of different stocks without a lot of heavy exposure to only a select few. But even then, some of the largest are very reliable companies like Johnson & Johnson, which should probably be on today's list, even though it's not, but also my favorite bank stock in Chase, a great kind of recession-proof company similar to Johnson & Johnson in Procter & Gamble, and even some telco giants like Verizon and AT&T that pay some very nice dividends as well, along with some great tech stocks as well like Intel and Cisco. And then if we dive deeper into the list, we can find even more stocks with gigantic growth histories like PepsiCo, Coca-Cola, and 3M, just to name a few. And I don't want to spoil today's list right now, but I will just add that literally every other stock that we will be talking about today is actually owned in some way by this ETF, so that should also be saying something. Add it all up though, and I think that this is definitely a solid choice to consider as a long-term dividend investment. And by the way, just like in typical Vanguard fashion, their expense ratio is tiny at just 0.06% per year. And if you don't know what that means, ETFs basically have these like annual fees that we call expense ratios, but at 0.06%, it's literally one of the lowest you will find out there. It's basically just 60 cents for every $1,000 you invest, so you really shouldn't even notice it. Okay guys, moving on to the individual stocks, coming in at number 2 here, that's going to be one of my favorite biotech stocks that still trades at a reasonable valuation along with a very high yielding dividend, and that is of course ABBV. Ticker symbol is ABBV. Now, this one does carry some risk that we will talk about in just a second, but once I saw them crash back in 2019 down to the $60 range, I just felt that the stock was way too attractive to keep ignoring it, and I ended up buying into it for the first time ever. By the way, this chart doesn't show it well here, but they actually did drop to the 60s again this year during our stock market crash back in March, but today the stock has recovered all the way back up to the $90 range, which would lead you to assume that the valuation and the dividend would no longer be attractive, right? Well, not only are they still attractive, but they're actually still some of the best in the market. When looking at the valuation, their forward P ratio is only around 10 and is over 70% cheaper than the sector median. That's a huge difference, especially considering the very large dividend that they pay out. You'd think the stock would be more expensive. In fact, their dividend currently yields close to 5%, despite the payout ratio still being pretty low at less than 50%, and the 5-year growth rate being extremely high at over 20%. So this is actually a very good dividend growth stock, and those usually trade for a premium. And perhaps the best part of all is the dividend growth history. I know it only says 7 years there, but that's because they were that's actually the year that they were spun off from ABBV Laboratories. But once you include that history, which pretty much everyone does, AbbVie's growth history is actually a massive 47 years in a row, which is almost dividend king status. Now, the risk comes from their best-selling drug Humira losing patent protection, which it already has in Europe and will soon lose it here in the United States as well. But in my opinion, there's a few reasons to be optimistic about AbbVie's future despite that. For one, they recently won a lawsuit that will help them hold on to Humira's market share in the US for at least a few more years, helping them rake in billions of dollars before the biosimilars really start to eat away at their sales. Meanwhile, this buys AbbVie extra time to keep building out their robust pipeline of new drugs that will help them make up for the lost Humira sales in the future. This is clearly evident in the success that they're already seeing in new immunology drugs like Skyrizi and Rinvoq, along with blood cancer drugs like Imbruvica and Venclexta. Not to mention that the acquisition of Botox maker Allergan that just recently closed, along with a very lucrative licensing and collaboration deal with Genmab, should only boost AbbVie's free cash flow in the future that is already sky high at over $13.5 billion over the past year alone. That should easily help them continue paying the already very large dividend, and overall I just can't really think of too many other biotech stocks out there that have as an attractive dividend or valuation as AbbVie, and for that reason I think they deserve to be on today's list. Okay, now moving on to stock number 3, that's going to be another one of my largest and personal favorite dividend stocks in my portfolio, and that's PepsiCo. Ticker symbol is PEP. And this one is very simple, as there's almost nothing bad that I can really say about them. The yield is great at over 3%, the growth rate is pretty close to a double-digit percentage, and that's even after having already grown that dividend for nearly 50 years in a row, which will give them dividend king status once they cross that 50-year mark. The only negative is the really high payout ratio at over 76%, so I really don't see that dividend growing much in the future, but at the very least, it is still one of the most reliable 3% plus dividends out there that you can likely count on all the way into retirement. And that's because PepsiCo has one of the most stable and reliable businesses out there that consistently brings in high sales along with solid profits year after year. In fact, despite the economy being so heavily destroyed this year and companies expected to post negative growth, PepsiCo is actually expected to be flat and then grow sales by another 5% the year after, despite already being so massively large. Again, that's a testament to their wide variety of products and diversified business that, in my opinion, is much better than their biggest rival in Coca-Cola, who primarily focuses on selling beverages mostly, while PepsiCo, on the other hand, is much more diversified with solid food brands from their Frito-Lay and their Quaker food brands, including Doritos, Fritos, Cheetos, Lay's, Quaker Oats, and more. That isn't to say, though, that PepsiCo doesn't also have a very large drink portfolio that even rivals that of Coca-Cola, as just some of their most popular brands include sodas like Pepsi and Mountain Dew, water like Aquafina and Life Water, high-growth sparkling waters like Bubbly and SodaStream, sports drinks like Propel and Gatorade, and even an exclusive partnership with Starbucks to bottle and sell some of their products as well. But the point is that their solid food segment is what I really think kind of sets them apart. In fact, in the disastrous second quarter that some economists were even predicting would send US GDP crashing by over 50% at one point, PepsiCo was actually able to survive it relatively unscathed thanks to their diversity. Organic sales overall did drop slightly by 0.3%, but that could have been a disastrously worse quarter if it wasn't for their Frito-Lay and Quaker segments that actually soared by 6% and 23% respectively. Just another clear example of how that diversity can really save you when you need it most. Of course, a solid company like this almost never really trades for a cheap valuation, but if you can get it during a dip, which you can see on this 5-year chart here that they definitely do have dips on occasion, and you just kind of keep adding to your position every time it does, then you'll likely make a lot of money both from the stock price and from the amazing dividends over the long term. I really can't see a scenario where I'd want to sell the stock myself, at least not anytime soon, and I do think it deserves to be on today's list. Alright guys, moving on to stock number 4, we're going to go with my personal favorite utility and energy stock, and that's going to be Next Era Energy, ticker symbol is NEE. And the reason I like this one the most out of really all the different energy stocks out there is because Next Era is focused on the future of renewables rather than older legacy kind of businesses or industries like coal, oil, and gas. Now, that isn't to say that they don't currently use those methods as well, but most of that is cleaner natural gas, and they have huge ambitions for providing more and more energy from wind and solar in the future. In fact, their Florida Power and Light subsidiary is aiming to install more solar capacity than any other regulated utility in the entire world. And here in the United States, that company is already the largest electric utility in the entire country, measured by retail electricity produced and sold. But it doesn't stop there. Their other subsidiaries dominate as well, like Gulf Power in Northwest Florida, Next Era Energy Services across North America in residential and commercial markets, Next Era Energy Transmission that develops, finances, and maintains various energy transmission projects and infrastructure, and of course their energy resources business that, together with their affiliates, generates the most renewable energy from wind and solar in the entire world, while also being a major competitor in battery storage, which is hugely important for renewables that tend to be unreliable because of the times when the sun doesn't shine or the wind doesn't blow. But by storing energy when it does, you can get much more reliable and efficient energy. And NextEra is all in on this, as they're set to spend another $1 billion on the infrastructure next year, despite the global health issue forcing so many companies to actually cut costs because of the weak economy. Important moves, though, that NextEra's CEO says will help them reach close to 24/7 power at a lower cost than gas or coal-fired plants by 2025. Speaking of the weak economy, though, NextEra is still managing to put up some very healthy growth rates and are expected to continue doing so even through this year and the next. Unfortunately, though, that strong current performance coupled with the bright future means that you do have to pay a premium for the stock, as it almost never dips, as you can see on this 5-year chart here, and year to date they're already up over 8% as well and are not too far away from an all-time high. But at least you get a very nice and growing dividend in return at over a 2% yield, a double-digit growth rate, and a solid 25 years of consecutive growth. Given the bright future, I really don't think this dividend is going anywhere, and NextEra seems like a decent stock overall for the future. Okay, now that one was admittedly a pretty small yield, so let's switch things up now with a stock that holds the highest yield of the entire list, And at stock number 5, that's going to be AT&T. Ticker symbol is T, which carries a huge dividend yield of about 7%. And with such a high yield, you'd think that the growth history couldn't possibly be very large, but in fact, they've actually grown it every single year for a gigantic 36 years in a row. Of course, the payout ratio and the 5-year growth rate are each a bit high and low respectively, but I think anyone would be willing to make those trade-offs for such a large current yield. Now, I've talked a lot about AT&T in the past, so I'll try to keep this short and sweet so that we can wrap up the video here in just a second. But here's the thing with AT&T. At a time when so many stocks are, in my opinion, overvalued because of how weak the economy is, AT&T is still trading in my favorite kind of price range of less than $30 a share. In fact, most of my stocks in my portfolio are up by very large amounts right now, as I have incredibly low cost basis on most of them, but AT&T is one of the very few that is still trading at just about the same price that I've really paid for it on average. And that's because it's actually down by over 30% from their 2016 highs. Now, there is good reason for this, as AT&T has been bleeding cable TV subscribers for a pretty long time now, as you can see on this chart here of that downward slope over the past few years. And that's definitely not what you'd like to see, considering the huge amounts of money that they pay to be even more exposed to that market in recent history. In 2015, they acquired DirecTV for almost $50 billion, only to later acquire Time Warner in 2018 for another $85 billion. Two massive moves that only further damaged their balance sheets, as they now sit on nearly $150 billion of just long-term debt alone. And my worry is how much that might drag them down in the future, as a combination of the weak economy along with people staying home because of the health crisis, I think will likely mean that more people continue canceling their overly expensive cable TV subscriptions while also skipping movie theater trips, which AT&T commands the second most box office market share, only behind Disney. However, there's at least 3 saving graces worth mentioning. Number 1 is their new video streaming service called HBO Max that has a gigantic library of over 2,000 movies and TV shows, including fan favorites like Detective Pikachu, Lord of the Rings, Harry Potter, South Park, Friends, Rick and Morty, Game of Thrones, all of the DC Universe, and much more. That alone should help patch up some of the bleeding from video subscribers. Meanwhile, number 2 is that they're still one of the largest internet and telephone giants in the entire world, with the most US market share in wireless subscribers, which should only continue to grow in the future thanks to their rollout of 5G, which, by the way, Gartner Research projects that the market share of 5G handsets will soar from just 12% this year to over 40% by 2022 and over 50% the year after. That should help boost demand for 5G coverage, which carriers will likely charge higher prices for. And finally, all of that leads to number 3, which is that AT&T is a gigantic cash cow that generates more free cash flow than the vast majority of other companies out there, doing almost $30 billion last year alone. That helps them not only service their debts, but also keep paying that giant dividend. Add it all up, and I think AT&T should definitely be on the list for collecting really large dividends over the long term, although admittedly they do carry some larger risk in return. But there you have it, guys. That's my list for some of my personal favorite dividend stocks for the long term. Let me know how you feel about these stocks, and if there's any that you think should be on the list, let me know which stock you would take out and which you would replace it with. And if you guys would like to see a part 2 of this video, maybe we can do another 5 stocks in the future, let me know about that down below as well in the comment section, and I'll be sure to make that video for you guys if there's enough demand. But anyway, I want to say thank you guys so much for watching the video. I hope you enjoyed it, and I will catch you guys in the next one. Stay safe out there, take care, and I'll see you guys later. Bye-bye.